Would you believe there is an investment option that's generating yields of up to 4.7% right now while providing exceptional stability? In today's volatile market, most investors are either accepting minimal returns for safety or taking on excessive risk, chasing higher yields. Today, I'm going to show you something that might shock you: why the smartest investors build stability into their portfolios even when pursuing ambitious returns. And money market ETFs are one of the most overlooked stability tools that deserve your attention. So, welcome to my channel, where we examine strategic investment approaches for European women looking to build wealth. Today's information could literally change your financial future, because you are going to explore how money market ETFs are currently generating yields that were unthinkable just 2 years ago, all while providing the stability many portfolios desperately need. Let me show you the numbers that most investors completely miss. I'm Justina, and welcome to Money on My Mind, where I break down intelligent investment strategies for European women and everyone else, of course, who want to build sustainable wealth. Why do I do this? Because financial freedom shouldn't be complicated or exclusive. I believe investing should be accessible to everyone, regardless of income or background. This knowledge is your passport out of the rat race and your foundation for true financial security. As a mother of two who recently went through a divorce, I know firsthand how financial education can transform your life. If I had understood these principles just a few years later, I would have made a completely different decisions, felt secure in my financial future, and never experienced those desperate moments of counting coins to afford groceries for a week. I've broken through so many limiting beliefs about money, and once I did, everything changed. I finally understood how money actually works and how to make it work for me. Now I'm passionate about sharing these insights with everyone struggling with their finances. If you're ready to see how the right knowledge can set you financially free, you are in the right place. So let's dive into today's episode into money market ETFs, what they are, how they work, and why they might be the perfect addition to many investors' portfolios right now, especially in this high interest rate environment and uncertainty in the world, with stock turbulences and high volatility. Before we get started, let me give you a quick snapshot of what we'll cover: what money market ETFs actually are, the impressive yields they are currently offering compared to bank accounts, how investors can use them as effective stabilizers in the portfolios, and some leading options for European investors. Let's get right into it. So, what exactly are money market ETFs? Money market ETFs are a subset of exchange-traded funds that invest in short-term, high-quality debt instruments such as treasury bills, commercial paper, and certificates of deposit. Their primary objectives are capital preservation, liquidity, and returns that closely track benchmark overnight interest rates. According to the comprehensive research on money market ETFs, these funds are designed to preserve capital while generating modest returns, often exceeding those of traditional savings accounts. In fact, as of February 2025, many money market ETFs are yielding between 4 to 5 annually, and that's significantly higher than what your bank is offering. Let's look at some concrete examples, like the PIMCO US dollar short maturity UCITS ETF currently shows an estimated yield of 5%, while the PIMCO sterling short maturity UCITS ETF shows 4.73%. Money market ETFs trade on exchanges throughout the day, offering exchange liquidity and flexibility. This means you can buy and sell them just like the stocks, making them incredibly accessible. Unlike longer-term bond funds, money market ETFs have minimal duration exposure. For example, the PIMCO US dollar short maturity ETF has an effective duration of just 2.2 months, and the PIMCO sterling short maturity ETF has a duration of 6.2 months. This extremely short duration makes them less sensitive to interest rate fluctuations, a critical advantage in today's volatile rate environment. Let me show you exactly how they compare to other investments. And look at this chart from the Just ETF page. Research shows that the performance of world equity ETF versus a money market ETF versus a bond ETF from 2020 to 2023. Notice how the money market ETF line stays remarkably stable while bond ETFs experience significant volatility during rate hikes. Now, let's dive deeper into how money market ETFs actually work and what makes them so effective at preserving capital while generating income. Money market ETFs operate under strict regulatory frameworks. For instance, in the US, SEC Rule 2A.7 mandates that at least 25% of a money market fund's assets must be daily liquid assets, while 50% must be weekly liquid assets. These rules ensure that fund can meet redemption demands promptly without resorting to the fire sales. The portfolio composition of these ETFs typically includes investment-grade corporate bonds between 45 to 61% of holdings based on the PIMCO ETFs we analyzed, securitized assets, mortgage-backed securities, then its quasi-sovereign bonds, and short-duration instruments. The weighted average maturity of these portfolios is typically kept below 60 days to minimize interest rate sensitivity and maintain high liquidity. What makes money market ETFs particularly attractive in the current environment is their responsiveness to interest rate changes. When central banks raise rates, as we've seen in recent years, money market ETFs quickly adjust their portfolios to incorporate higher yielding securities. Let me explain why this matters right now. In periods of rising interest rates, longer dated bond ETFs take capital losses as yields increase. However, money market ETFs' capital value are almost immune to this effect because their assets mature so quickly. Moreover, money market products rapidly reinvest the principal as their holdings mature, so they quickly benefit from the higher rates of interest offered by newly issued debt securities, something your bank is typically very slow to pass on to the customers. The bottom line is that money market ETFs are much less volatile than bond funds, and they are quicker to pass on to the benefits of rising interest rates, which banks are often slow to do. Look at some of those ETFs. Have you ever seen such stability? Now, let's look at some actual performance data. According to the PIMCO fact sheets, over the period from February 2024 to February 2025, the US dollar short maturity ETF returned 5.52% and the sterling short maturity ETF returned 5.62%. That's substantially higher than typical bank savings rates, with almost none of the volatility of equity or longer duration bond investments. So how exactly can investors incorporate money market ETFs into their portfolio? So let's explore an implementation strategy step by step. First, investors should determine how much stability they need in their portfolios. Financial experts often reference what's called the stability paradox approach, where having even a modest allocation to ultra-stable assets actually enables safety pursuing higher overall returns with the remainder of the portfolio. Based on the risk matrix analysis from investment research, many advisors suggest starting with a 30% allocation to stability assets like money market ETFs. With this allocation, even if volatile assets crash by 60%, the total portfolio would only drop by about 37%. Still a significant hit, but manageable, and the investor remains positioned for recovery. One excellent way to implement money market ETFs in your portfolio is as a holding place for capital you've set aside for the future investment opportunities. Many investors follow a disciplined dollar-cost averaging DCA approach, investing a fixed amount month by month into their core position. But it's also strategic to maintain a liquidity reserve that can be deployed when exceptional opportunities arise. Rather than letting this opportunity fund sit idle in a low-interest bank account, money market ETFs offer a compelling alternative, and they provide, first, higher yields, currently 4 to 5% versus typical bank rates of 1 and 2%, near immediate liquidity when opportunities emerge. Then third, minimal price volatility, preserving your capital, and four, better inflation protection and cash. For example, if you have 10,000 euros reserved for potential market downturns, or special situations, placing this in a money market ETF could generate 400 to 500 annually while keeping those funds readily accessible. When a buying opportunity presents itself, perhaps during a market correction or when specific assets become undervalued, you can quickly liquidate the necessary amount from your money market ETF position. This approach essentially lets your dry powder generate meaningful returns while waiting to be deployed rather than slowly eroding to inflation in a traditional savings account. For European investors, here are some of the top money market ETFs options available in 2025. So I go to justetf.com page and I select money market ETFs just through the search engine, and I get to see all 25 available money market ETFs, and they can be accumulating or distributing. So accumulating ETFs, they collect all the dividends and the passive income paid inside the ETF, and they use the money for growth, versus the distributing ones, they do distribute monthly or quarterly the passive income to their investors. So as example, the mentioned PIMCO US dollar short maturity UCITS ETF, it's a distributing choice and we can check its dividends. So it's currently 5.20% of dividend yield per year, and you see that passive income would reach you month by month. Through this page, you can also see their growth in 1 year, also how their chart looks. And look at these super stable assets, which looks crazy. It doesn't even look like investment vehicle because it's so crazy stable. For example, we can also check this Amundi Smart Overnight Return UCITS ETF, and we can come here to check the dividends. It's 3.9% of yearly dividends from the amount that you hold inside such ETF. And it pays dividends yearly. So for holding your reserve, your cash reserve in such ETFs, as example as this one, you get 3.9% of dividend yield. If you want to invest in such choices in money market ETFs, you choose the one that you like the most from the metrics. Then what you do, you just go inside here to the actual ETF and you copy an assigned code. And I just press this and it's copied to clipboard, and then I go to my brokerage account. The one that I really like is Freedom24 because it has super friendly user interface. What I do, I just paste the ISIN code right here and goes by EGV2 as a ticker and .eu, which let us know that it's traded in the European stock market. So we go here, it's UCITS compliant, which is also needed for the European investors. Then I press here invest and I choose if I want to buy it with limit price or the market price. So let's say I want to get limit price, and let's say I want to buy 1 unit of this for 100 euros. Yes, one piece. What I do, place buy order. We do this and in less than 1 minute, we already have money market ETF in our portfolio. When deciding which money market ETF to choose, consider first, the currency exposure. Match the currency of your liabilities. Second, expense ratio. Lower is better for these products. Third, liquidity. Check trading volumes and bid-ask spreads. 4, yield. Compare the effective yields after accounting for expenses. One important consideration: unlike bank deposits, money market ETFs are not covered by deposit insurance schemes like the FDIC in the US or equivalent programs in Europe. They are, however, protected by the principle of special assets, both in the event of bank failure and in the event of the insolvency of the ETF provider. For implementation, think about dollar cost averaging into your chosen money market ETF over a period of 1 to 3 months rather than investing lump sum. This approach helps smooth out any short-term fluctuations in price. Looking ahead to the rest of the 2025 and beyond, money market ETFs are positioned to remain an attractive investment option for several reasons. First, central banks' monetary policies significantly influence money market ETF yields. While many central banks have begun cutting rates, the pace of cut appears to be slower than initially anticipated, which means these ETFs will likely continue offering attractive yields compared to traditional savings products for the foreseeable future. Innovation in the money market ETFs place continues as well. Asset managers are launching specialized products just like ESG-compliant money market ETFs to cater to evolving preferences of both sustainability and stability. The outlook for money market ETFs in different regions varies based on their respective central bank policies. Euro-denominated funds will be influenced by ECB policy. JBP-denominated funds will follow the Bank of England rates. USD-denominated funds track the Federal Reserve's rate decisions. For European investors specifically, the outlook for 2025 and 2026 suggests money market ETFs will continue to offer superior yields to bank deposits even as rates potentially decline from their peaks. Before we conclude, let's address the potential risks of money market ETFs. So the first one, interest rate risk. Although minimal compared to longer duration bonds, money market ETFs can experience minor value fluctuations when rates change suddenly. Credit risk. While rare, defaults on underlying securities could impact fund performance. Prime money market ETFs that hold corporate commercial paper are more exposed to credit risk than government-focused alternatives. Liquidity risk. During extreme market conditions like March 2020, COVID-19 turmoil, some funds faced challenges meeting redemption demands. 4. Regulatory risk. Changes in regulations could affect funds' operations and yields. To mitigate these risks, think about diversifying across multiple money market ETFs, regularly reviewing the underlying holdings of your chosen ETFs, staying informed about relevant regulatory developments. The key thing to remember is that while money market ETFs are among the safest investment vehicles available, they are not completely risk-free. So there you have it. Money market ETFs offer a compelling combination of safety, liquidity, and enhanced yield that makes them a valuable component of many well-structured portfolios. While many investors are either taking excessive risks on speculative plays or settling for minimal bank interest rates, you now understand how these financial instruments can help build more resilient portfolios that can weather market volatility while still generating meaningful income. Remember the stability paradox concept we discussed. When a portfolio has a secure foundation with instruments like money market ETFs, investors have more flexibility to pursue higher returns with a portion of their portfolio. This balanced approach can help manage overall portfolio risk while still seeking growth opportunities. If you found this video valuable, hit that subscribe button and notification bell to join our community for strategic European investors. Drop a comment below sharing your thoughts on money market ETFs and how you might use them, or if you already do. Thank you for watching and being with me. Bye. According to the PIMCO Fab, according to the PIMCO Fab, according to the PIMCO Fab.